And with that, we're going to head into the second closing bell of the week. Here we are.
Another down day for the markets. All three of the major averages ending lower than NASDAQ. You can see the worst performer of the three off nearly 1.5%. Let's talk about what this means for the final trading days of the year and, of course, into 2023. We want to bring in Keith Fitz-Gerald, Fitz-Gerald Group Principal, and also Tim Pagliara. He's CapWealth Chief Investment Officer. Keith, let me start with you because I know you had high hopes for a strong end-of-year rally. Doesn't look like certainly that is materializing, although maybe we could see the two final trading days of the year end on an optimistic note. But what's your big takeaway from some of the selling that we've seen over the last couple of days?
Well, it's an interesting question, interesting time of year. It's highly technical. It's driven by what is effectively a global deleveraging over inflationary concerns related to the cost of capital, not necessarily inflation itself. So, as much as I would have loved to have seen a rally coming to the end of the year, this is uniquely at the hands of the world central banks, which are determined come heck or high water to raise rates when arguably they're already too tight, waited too long.
Keith, you mentioned central banks, the operative word here. What's your expectation for the Fed, especially that first meeting and then beyond? Probably going to slow the hiking pace, but at what point do we get that all coveted pivot? Does it even matter at this point?
Well, I think it's more of the latter. It doesn't matter at this point. I think they lost the narrative a long time ago. Frankly, I don't have a lot of respect for that office right now. The fact that we're supposed to suddenly believe everything they say and that they have a handle on it after such glaring evidence that they don't, and $60+ trillion that's been destroyed in the interim. So, there's not going to be a warning bell when they pivot, when they relax. My expectation is mid-year, the inevitable is going to be upon them, and they're going to have no choice because capital markets are either going to be in a full-fledged revolt or simply not paying attention.
Tim, let's get you in here. Your thoughts on what the Fed has already done so far and what it needs to do or what it should do at this point going forward.
Well, I think the operative thing at this point is how much inflation are they going to tolerate and at what level do they have to raise rates going into the first half of next year to get it under control. So, we believe that inflation is going to be stuck somewhere in the 4 to 5% range. And if that's the case, then that would suggest that there's at least 2 to 3 50 basis point hikes going into first half of the year.
And Keith, any outspoken suggestions about what sectors, what styles, investment opportunities you're thinking about as we head into the new year?
Well, I tell you what, my colleague makes a very valid point, 2 to 3, hikes into the middle part of the year. So I think now is not the time to be a hero. It's time, if you're a golfer, to keep it on the fairway. Just keep that ball where you can see it. To me, it's companies like Lockheed Martin, it's companies like Pfizer that are going to be stable dividend producers, low beta, but lots of growth no matter what happens, recession or not. And you got to hold your nose and wade in on a day like today.
Very tough, though, to keep the ball on the fairway. Tim, when there is so much uncertainty out there right now, what is your main message to investors going into the new year?
I'd avoid companies that are going to have to access the capital markets for the first time in 10, 15 years. Corporate bonds are starting to look attractive. So clipping a coupon at 8%, when you look at the 22-year average of NASDAQ, it's somewhere around 5. That starts looking attractive again. So the savers are going to be rewarded, the speculators are not, and we're not going to have the kind of accommodative Fed policy going into the next 5 to 10 years, I believe, that we've had in the last 5 to 10.
And Tim, your thoughts on index investing? Actually, I'm getting from your notes. I'm going to throw away the punchline right here. Index investing is not good right now. I want to get your opinion on how that settles into, or how that's framed by the larger debate between passive and active investing. How does that look in the new year?
I think it's going to be a stock picker's market. I think part of what you're seeing right now in the downdraft of, say, something like Apple is related to shifts in the index. That's part of the downdraft in NASDAQ, all the NASDAQ stocks. And so I would be very selective. We don't believe in passive investing. We're active investors, and we prefer individual securities. And I think it's time, that style of investing is going to be back in vogue again.
Keith, when it comes to earnings, that's going to be a huge focus here for investors in the new year, because certainly a number of estimates out there are calling for a recession. But when you take a look at the earnings estimates, that doesn't necessarily reflect that at this point. Do you think more downward revisions are ahead? And I guess how bad could it potentially get for some of those names?
Well, that's the multi-trillion-dollar question, right? I mean, this is why I watch your show, so you can help me figure that out. All joshing aside, we have no idea how bad it's going to get. But what we do know from history, and this is very clearly shown, is that the markets typically bottom, find a footing before the economic conditions do. So that's a presupposition that the markets are forward-looking. So when it comes to companies like Apple that are just getting shellacked right now, the question investors need to ask themselves is, does that have the power to continue to change the world? I submit the answer is yes. So, I own it and I'm keen to buy more, especially if there's more selling ahead.
And Tim, your thoughts on the upcoming earnings season?
Well, we went into this year with some of the highest valuations I've seen in my career in an environment where interest rates were zero. And so you're going to have some compression just in the multiples as interest rates have risen. And now with the slowing of the economy, you're going to see some downward revisions in earnings. It's just a question of how much, how far have the valuations fallen, and is the earnings season going to make that worse, or are we at a kind of a stable point here?
Well, we're going to have to leave it there. But Keith Fitz-Gerald and Tim Pagliara, always great to see you.